Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. Well, it is the season, right? Right now is the launch of all the Meg 7 stocks, the FANG stocks, whatever acronym you can come up with. They're probably announcing earnings this week. It was kicked off last week by Netflix, which had a very strong earnings report, but got beaten up for it, mainly because it had such a good run up after its last earnings that people took this opportunity to sell it off. We did a short spread. Well, we did a skip strike butterfly as an alternative to a short spread in Netflix and made the net credit. But and I did kind of want to mention this, if you were following the short spread trade around Netflix, one of the wonderful things about the skip strike butterfly as an alternative to a short call spread. I'm going to say that again. The skip strike butterfly with calls, we were on we're neutral to kind of bullish with a skip strike butterfly, but there was an alternative to doing a short call spread, which is neutral to definitely bearish. Okay. If you put that position on and the market goes down like Netflix did after their earnings report, there's not necessarily a reason to get out of the trade. We only had a few days remaining until that expiration date on our option contracts, and we have a hedge built in. So if the market did come back and land within our strikes closer to the expiration date, that would probably be a good thing in the Netflix trade, and we'd probably be able to put it on for a net credit and then close it for a net credit. So it's a totally different way to look at it. Now, the biggest thing about skip strike butterflies, they're very hard to do the trade if there's not an event around and get it done for a net credit. Now, in the SPX, it's not that bad. You got some volatility, some predictability from the index, but the fact that it's a $6,000 index helps things. So bottom line is you need premium to be able to pull it off. You're not going to be able to do a skip strike butterfly even in Coke around earnings. And I bring that up as a segue because that was the trade that we looked at on Friday. I'm sorry. And Coke is going to be announcing earnings. Now, the weirdest thing happened, I think, in that recently we had Pepsi announce earnings, and Pepsi actually moved, which is kind of odd. The stocks really don't move, and it's even shown by their volatility. A lot of the big soda companies, Coke, well, there's two of them out there, really, right? There's a few others, but the two main players trade even during earnings at about 25-26% implied volatility. So Coke had to run up with Pepsi. So we're actually, and I'll go back and review that trade. Not much has happened, but they will be announcing actually before the open tomorrow. I look over at my earnings calendar, and they'll be announcing before the open. So we'll know this answer quickly by the end of the day. And we had to go out actually a little bit further in time than normal to be able to get enough of a net credit to make it worth our while to do the trade. So here's our situation. Let's go to the Tradier Pro software. And we're looking at the August 15th expiration, 25 days away. But if we go to the 26 delta at this point in time, or about a 1 standard deviation move. So I'm going to jump. Let's jump to the earnings on the 25th. And the stock's right at 70, so this is perfect. So we're talking about $2. The expected move after earnings, if we bought the at-the-money call and the at-the-money put, we're not even $2. On the ask, we'd be $1.85. So just really not much of a move at all. It's putting us right at about 72. But that's going 4 days to April 25th. That's where the expected move is at. But look at even the front month volatility with an earnings report is at 30. You go out to the August 1st expiration, you're down to 22. And the strike that we're selling is 19, and the historical vol is around 18. So we're heading into the earnings report, and we got a 1% implied volatility jump. Kind of crazy to me that that is so low. And one of the things we had Pepsi announce earnings, very strong move, and I pointed that out on the chart. I guess we can go back and look at the chart, um, and we can see that one big pop on that day. So what we're going to do is sell that pop, that move up. This big red candle, right, or this big white candle right here. We had that pop up on their earnings, and we closed near the lows the other day, and today now we're up 26 cents today. We could have actually got out at the end of trading on Friday and made probably a dime on our 40 cents, but I wouldn't have done that. Right now we're at 40 cents. We put it on for 45 cents. We're up a nickel at this point in time. We sold the August 15th 72.50 call, so we're just outside the expected move. Not the expected move for August 15th, right? August 15th, it looks like it's about $3, a little less, $2.75. So we're about right there. 72.50 is what we sold, $72.50. Bought the 75, brought in a 40-cent net credit. I don't mind that credit. We brought in 45 on Friday. It's at 40 right now. And we'll just let this trade ride, see where we end up at. I think implied vols, I guess, drop precipitously, like 2% maybe after earnings. We'll see if we get back down to that historical level. But I do think after that earnings report, this will kind of collapse. Now, the big news is do they blow it away like Pepsi? Are the numbers incredible? Do they get a 7-8% move after their earnings, which this obviously is not priced in at this point in time? I don't think so. They had the run up. I think that we're going to sell that move. So that's where we're at. And that's tomorrow. So now let's get into something exciting. That's just a boring income trade in Coca-Cola. And we're going to look at, I'm going to look at Google. Google is one of the two big stocks on Wednesday after the close are Tesla and Google. Tesla, I'm not going to touch. Tesla is just tough because the numbers have been horrible for Tesla, but a lot of times Elon Musk works his magic and the stock goes up. This time I have no feel at all for what may happen in Tesla. I would think the path of least resistance would be to the downside. But who knows? Who knows what gets mentioned? Also, another interesting one to look at on Wednesday, because it's kind of becoming the darling of the stock market, is IBM. IBM is going to be announcing after the close. We got ATT in the morning on Wednesday. We have Capital One tomorrow night, which is going to be worth looking at. I don't want to trade it, but just to hear a little bit about the credit card world and the strength of the consumer or non-strength of the consumer and consumer spending and what's going on there. So that is always an interesting one to listen to and read about. And so we're going to go to Alphabet, and I want to get long. And so things change a little bit. When I look at Google is still struggling, and it's not because of the fundamentals. One of the things with Google is their active management style is to not say a lot of things. It took them forever to just separate out YouTube versus everything else at Google and search and everything else. Alphabet is a better term. I'm going to call it Google here today. And if you think about the company, it's one of the trades at one of the lower PE ratios relative to a lot of the to most of the Mag 7 stocks. It's that valuation there. They're doing a lot in the AI. They're spending money. They're hiring people. Their search has been hurt, and I have to admit that I don't use Google as much, but I do know that Gemini, their version of in the AI space, still has, to me, more information on little things that you want to search out. Like simple thing, I was trying to figure out my iPhone the other day. I had a question about it. Gemini was great to answer how iPhone works. They know insides and out because they've been in the iPhone for forever. So these things are, Google still has a corner on search, and I do think that they're going to excel. They've been beaten up because of AI, and I think AI might end up being one of their strengths. Let's leave it there. Okay. So I like the stock. I own the stock. I'm going to do a bull uh, we're going to do an open wing butterfly. And the difference is that Google's announcing on a Wednesday and they're not announcing on a Thursday. If they're announcing on a Thursday, might think about doing a different type of butterfly. But the fact that you have 2 full days until that expiration date, I'd like to do the open wing butterfly in Google. And I already set one up inside the what if calculator. So let's go to here and let's pull this out, and we'll send this one to the trade ticket. Check mark my boxes. And if we do that, I might as well just show it to you right here. We'll send it to ticket. It's going to go down here. Right now, it's a $2.32 net debit, $232, but we're going 15 points wide and then 10 points wide. So here's the scenario. We get activity very quickly by doing this setup. It's an alternative to doing the flat out bull call spread. That's the way that I would look at this butterfly, where you buy this option contract and sell this option contract. We're going to get the benefit of selling 2 of these and then buying one over here that is a very cheap option that's trading for about 8 cents, and that's just our protection. We're well within the 1 standard deviation move in that we only need a 2-point movement to the upside. This long call option is pretty expensive, $3. Going out to the 7/25 expiration. So we're going to go to this Friday. That's simple. Duh. We're going out to this Friday. And so if the market does land somewhere around the expected move, let's go back and figure out exactly what it is for the earnings. $4, we'll call it 6 and 4. We're right about $10, a little less than $10. So 190, that puts us at 200. We're selling the 210. The 200 is a 22 delta. That's about right. So that's around where the expected move is, right about that 200 strike. If the market continues on up beyond that, a 1 standard deviation move, oh gosh, we're at 202. We could even slide it down a little bit. Yeah, I don't mind this at all. If we did the 207, I'm going to bring in another 30 some cents, but then we don't quite get as much on the upside. All right, I don't mind this at all. We're at 227 on this trade. Market's at 188.88. Interesting. All right, so let's look at a small adjustment on this trade. Let's get rid of the 210 and look at the 207 and a halves. And let's just put it right here. Let's do it this way. Move that, and then on here, we're at 220. We can't go down to 2.5, so we got to do the 215. Yeah, let's try that. Yeah, 205, but we don't have as much upside potential. Send to the what if calculator. So if we do it this way, we're paying 204 and our max upside is 3. Yeah, that's not a bad alternative, especially thinking about where the expected move is at. So here we're going to put up $2. If we bought the option contract outright on the call side, we're paying $3. We're selling 2 50-cent option contracts, and then we're going to pay for a 17-cent option contract. Yeah, I think I like this one better. Let's make this the official paper trade. We're going to buy the 195 strike call. We're going to sell 2 of the 207.50 strike calls, and then we're going to buy 1 of the 215 strike calls. We're going to pay $2, and I'd be really like, I see $2. It's $2 sold for $2. And then the difference between the strikes on the downside is $17.50. So 195 plus 1750, that puts us at 207.5 minus 195. is 1250, and the difference between 215 minus 207.05, that's 750. All right, so that leaves 1250. That leaves $5, and we paid $3. Yeah, I like this. So 1250 is the most this can trade for, minus the $2, obviously, that you paid for it, which is if we landed right on the 207.50 strike, we landed right here. So this would be about $1,000. It's showing you over here minus whatever it grabbed for the price. And so you can make as much as $1,000 if we land here. If we land anywhere in the middle, we're doing pretty well. We needed to get to about 197. That's our break even on this. And then if the market continues on up, from this point on up, we can make $5. It would be trading for $5 minus the $2 we received. So we would be up as much as $3 on the trade. We need the stock to get to 97. That's where 197 is where we start doing well on this trade. Stock's down in this range to start with. You see the line here. So to start with, we're all pretty good if we don't quite make it there. I would just get out of the trade if the stock went nowhere. But on the way down, our risk is going to be $2. So trade it accordingly. And I don't mind putting this on right now heading into the earnings. Google hasn't been one of those stocks that has had this huge run up like Netflix has into earnings. It's had a very strong chart, but I still think it's valued just fine. So like if we even run over and we look at the Google trade, it's been a very solid stock, but it's still not, knocking it out of the park. We're still not at all-time highs up here. Right here, interesting area. PE is trading at 20 times earnings right now. Forward PE is probably going to be less than that even. Yeah, solid lead in. And on top of it too, we had a lot of chop, so here's let's go out 1,000 days here and look at we got the 200-day, 2,000. Yeah, that's okay. We froze. Okay, so we got the 200-day right here going up above the 20-day moving average to go along with it. And we've had kind of a strong move here just recently, but I don't mind being long going into earnings because there is some room. We're in this messy period right in this range, right where this gap down was. Yeah, interesting. Yeah, interesting. I like the Google trade as a speculative trade, and I like it as a long-term trade. All right. Do we have any questions or comments on any of the other trades that we've looked at so far? The Coke trade is still live. I still think you can put it on. I still think it's a solid trade that's going to happen, tomorrow morning. We're going to get a quick answer. Google's after the close. And then as we get into the end of the week, next week, we're going to have Amazon, which is another stock that I think is doing well and not getting the respect it deserves in the AI space and what it's been doing in cloud. And then at the end of the month, we got NASDAQ. NASDAQ's going to be an interesting one on Thursday before the open. That's the option contracts, which is counterintuitive, but the exchange that trades options is not as the markets aren't as good in that stock. Let's look at the markets. But I do expect, just with the volatility of the marketplace, just in general, 23 times earnings or 23 implied volatility. This stock is, the chart's going to be like, you don't hear much about it, but the chart is kind of crazy. For a difference, look at that. Look at the move up we've had in the NASDAQ, going all the way back to April. From these lows, I mean, it blew through the 20, blew through the 50. This is actually a bearish sign. No, this is the 200-day moving average moving through the 50-day moving average to the downside. Yeah, that's usually a bear sign. And then we break through to the upside, and here's where we end up trading, all the way up at 89. It's a solid stock, trading at 30 times earnings now, getting a little pricey, but I do expect to see good things out of the NASDAQ on Thursday and their report because of the volatile trading that we had at the beginning of the year, or throughout the quarter, I should say. All right, I don't see any questions that we have. So the paper trade for this week is, well, we put one out on Friday in Coke, and we're going to look at one in Google, and then we'll see what we end up with at the end of the week. So that's it for this episode of Options Guide TV. We'll see you this coming up Wednesday at 11 a.m. Eastern Time for the next edition of Options Guide TV. Please check us out inside the Tradier Hub, hub.tradier.com. And also, you can watch it on YouTube and on my X profile. My handle is @BrianOverby, at my name. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.